Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. In today's session, we are going to discuss two very important RBI press releases. The first one is regarding the RBI that has unveiled, that has brought the risk-based deposit insurance premium. So it is actually the DICGC with the approval of the Reserve Bank of India, which has brought the risk-based deposit insurance premium. We will understand the basic idea about this risk-based deposit insurance premium and we will understand the background and everything so that you have the clarity about this article. Okay, the second RBI press release, the second news article that we are going to discuss about is the RBI Digital Payment Index, which is a very important index of the Reserve Bank of India, and year after year we have seen the question from this index in the RBI Grade B examination. Okay, so give me a thumbs up if I am clearly audible and the screen is visible and everything is fine. So let's start with the session now, and today we will discuss these two articles. So before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session. Okay, and the link for the Telegram channel is provided in the description box below. Now let me tell you that this risk-based premium framework, it is very important from the RBI Grade B point of view, from the examination point of view, from the phase 1 as well as from the phase 2 point of view, as this is a new framework that has been brought with the approval of the Reserve Bank of India. And after years, there has been a change that we have seen in the framework. So let's start with the session. So first of all, risk-based premium framework for the deposit insurance in India. So based on a comprehensive review, the Deposit Insurance and Credit Guarantee Corporation has, with the approval of Reserve Bank, decided to implement a new framework, that is a risk-based premium framework with effect from April 1, 2026. So what is this framework? Why it has been brought? Okay, so let's discuss this, but first let's understand about the DICGC, that is Deposit Insurance and Credit Guarantee Corporation. So DICGC, it insures the bank deposits. Okay, so basically if a customer is depositing the money in a bank, so the depositor's money is insured by the DICGC. So DICGC is the Deposit Insurance and Credit Guarantee Corporation that insures every depositor that is depositing the money in the bank till the limit of 5 lakh rupees, okay. So let's say you have deposited 3 lakh rupees and you have got the interest of 20,000. So your 3 lakh plus 20,000, that means 3.20 lakh. This is insured by the DICGC. So each depositor in a bank is insured up to a maximum limit of 5 lakh, principal plus interest. Your principal as well as your interest is also insured up to the limit of 5 lakh rupees. So I hope this is clear. And depositor, if a customer is depositing the deposits in different banks, so different banks, the DICGC insures the deposits in the different banks separately, so that the limit for 5 lakh is like in one bank, the limit for the insurance is 5 lakh, in another bank the same limit is being followed, okay, separately. So this is the idea, that your funds from each bank are separately insured. So DICGC insures every depositor that is depositing the money in the bank till the limit of 5 lakh. Your principal and interest is getting insured, okay, your principal and interest is getting insured till the limit of 5 lakh, and your funds in different banks are insured separately with the limit of 5 lakh each in the different bank. So the DICGC is the wholly owned subsidiary of the Reserve Bank of India. Now if it is providing the insurance, if it is insuring every depositor of a bank, and the depositors are able to trust the bank because of the insurance that is provided by the DICGC, now how the DICGC will give the money to the depositors when, let's say, this bank A fails. Let's say A bank is failing. Now how the money will be given to the depositors? From where the DICGC is getting the money? So DICGC is basically taking the insurance premium from each and every bank that the DICGC is insuring. So basically, if the DICGC is insuring 50 banks, from each and every bank the insurance premium is taken by the DICGC, okay. So in case a bank fails, the money is given to the depositors from the insurance premium that is collected by the DICGC. So DICGC collects insurance premiums from insured banks, and this insurance premium goes to the deposit insurance fund. So the DICGC is maintaining the deposit insurance fund for paying the depositors in case of bank failures. So it ensures the safety and security of your bank deposits, and it maintains the trust of the people on the banks. So this is the basic idea. The ICGC is providing the insurance facility and is taking the insurance premium from the banks. Okay, so this is the basic idea. Now, since 1962, the Deposit Insurance and Credit Guarantee Corporation has been operating the deposit insurance scheme. So since 1962, the Deposit Insurance and Credit Guarantee Corporation has been operating this deposit insurance scheme, where the DICGC is insuring every depositor of a bank till the limit of 5 lakh, the principal plus interest, and the DICGC is taking the insurance premium from the banks. Okay. Now DICGC till now has levied a flat rate premium. The insurance premium that the DICGC has been taking from the banks is a flat rate, that is 12 paisa per rupee 100 of the assessable deposits. Assessable deposits means those deposits that are going to be insured, okay, or assessable deposits are those deposits from which premium is calculated. So what is the meaning of the assessable deposits? Assessable deposits are those deposits against which the premium is calculated. So does DICGC insures all the deposits, all the depositors that are depositing in the bank? No. Actually, the DICGC insures all deposits in the savings account, fixed deposit, current deposit, recurring deposit, etc. Except that means these deposits are not insured by the DICGC. That is, the deposits of foreign governments are not insured by the DICGC. Deposits of central or state governments, interstate, interbank deposits, any amount due on any account of any deposit received outside India. So these are the deposits that is not insured by the DICGC. Accessible deposits are those deposits like the savings account deposits, fixed account deposit, the current account deposit, and recurring account deposits. So these deposits make the accessible deposits against which premiums are calculated. So I hope this is clear that out of the total deposits of the bank, there is a portion of the deposits, that is the deposits in the savings account, in the fixed account, in the current account, in the recurring account. So these deposits are the accessible deposits that can get insured, and against these deposits there is the insurance premium that is calculated. Now the deposits of the foreign governments, the deposits of the central state governments, interbank deposits, these are not under the accessible deposit. That means these deposits cannot get insured. That is the idea. So since 1962, the Deposit Insurance and Credit Guarantee Corporation, that is DICGC, has been operating the deposit insurance scheme. Since inception, the DICGC had levied a flat rate premium to fund the scheme. So the DICGC has been taking from all the banks that the DICGC is insuring. So for all the banks, the DICGC is charging a premium of 12 paisa per 100 rupees of the accessible deposit. Accessible deposit, I hope you know now that accessible deposits are the deposits of which the insurance can be done. Okay, accessible deposits are deposits in your savings account or fixed account or current account, recurring account. Accessible deposit does not include the deposits of state or central government or deposit of foreign government or interbank deposits and such. So accessible deposits are those deposits that can, like the part of which that can get insured, and against the accessible deposit the premium, insurance premium, is taken by the DICGC. Okay, and the flat rate is calculated, that is 12 paisa per 100 rupees of the accessible deposit. So this is the flat insurance premium rate that was taken from all the banks, 12 paisa per 100 rupees of the accessible deposit. Now this was paid on half yearly basis. Regardless of how well or poorly the bank manages its risks, all the banks had to pay 12 paisa per 100 rupees of the accessible deposits of these deposits. Okay, now this has to be paid on the half yearly basis. This had to be paid, that means 6 paisa per 100 rupees and 6 paisa per 100 rupees. So this had to be paid on the half yearly basis. Okay, now So we have understood about the background that till now the flat rate premium was being applied for all the banks, irrespective of the bank is well managed or the bank is more risky or less risky. All the banks had to pay 12 paisa per 100 rupees of the assessable deposit. Now, based on a comprehensive review, now the DICGC has decided to implement a risk-based premium framework where you can understand the bank that is more risky will have to pay higher premiums, insurance premiums, because the bank is more risky. So the bank should be paying more insurance premium. Where the bank is less risky, the bank should be paying less insurance premium. So now, rather than having the flat rate for all the banks, that is 12 paisa per 100 rupees, now it is said that risk-based premium framework will be followed with effect from April 1, 2026 in terms of the provision of the DICGC Act 1961. So which provides for differential premium rates. Now differential insurance premium rate will be followed for different categories of insured banks. The banks that have more risk will have to pay higher insurance premiums, while the bank that has less risk will have to pay less insurance premium. So I hope this is very much clear. We will discuss about the applicability also. The risk-based premium framework incentivizes sound risk management. So you can understand that if a bank is having good risk management, that means the bank is having less risk. So bank will be incentivized as the bank will have to pay less insurance premium. Okay, the bank will have to pay less insurance premium to the DICGC because the bank has sound management, because the bank has less risk. So RBI framework, that is risk-based premium framework, incentivizes the banks that are having less risk. They are having sound management. Okay, facilitates better managed banks. So better managed banks, they will have to pay a lower insurance premium than the card rate of 12 paisa per 100 rupees of assessable deposit. Okay, so the banks that are better managed, the banks that have low risk, they will have to pay less insurance premium in comparison to the card rate. Now remember that the card rate is 12 paisa per 100 rupees. Per 100 rupees, this is the card rate. So the better managed, less risky banks will have to pay less insurance premium in comparison to the card rate. Now enforcement. So as you know that this risk-based premium framework will come in effect from April 1, 2026, and it has been said that it will be reviewed at least once in 3 years. So in 3 years, it will be reviewed at least once. Now, how the risk will be identified? So it has been said that the bank that has less risk will have to pay, the bank that has less risk, that the bank that is well managed will have to pay less insurance premium, will have to pay less insurance premium. So there is a framework that is created according to which the risk will be identified for the banks and the risk score will be provided to the bank. The lesser the risk score is of a bank, the lesser the insurance premium will be. The higher the risk score, the more the insurance premium. The higher the risk score, the higher the risk, the more the insurance premium. Okay, so that is the idea. So risk-based premium framework includes a 2-tier risk-based rating methodology. So under the risk-based rating methodology, there is 2 tiers. 2-tier risk-based rating methodology. So under this methodology, under this method, the risk score has to be identified. The risk score has to be calculated for each and every bank so that according to the risk, the insurance premium can be taken. Okay, so risk-based premium framework includes a 2-tier risk-based rating methodology. So tier 1 risk assessment model and tier 2 risk assessment model. In the tier 1 risk assessment model, it applies to all the scheduled commercial banks other than RRBs, other than regional rural banks. Okay, the tier 2 risk assessment model, it applies to all the RRBs, regional rural banks, and the cooperative banks. Let it be the urban cooperative banks, the state cooperative banks, or the district cooperative banks. Okay, so tier 1 risk assessment model, it applies to scheduled commercial banks excluding the RRBs. Tier 2 risk assessment model applies to RRBs and the cooperative banks, all the cooperative banks. Okay, now the risk score, that is the risk profile or the risk score of a bank, will be determined by DICGC based on 3 components for the tier 1 and 2 components for the tier 2. What are the 3 components for the tier 1? Supervisory ratings of the Reserve Bank of India. Okay, so risk-based supervisory rating. So the risk score for the scheduled commercial banks will be determined on the basis of the risk-based supervisory ratings that has been provided by the Reserve Bank of India. The quantitative assessment of financial health through CAMELS parameters. CAMELS is, C is capital adequacy, ठीक है, A is asset quality, the M is the management, the E is the ethics, L is the liquidity, S is the systems and controls. So this is the CAMELS parameter. So quantitative assessment of financial health through CAMELS parameter, that is capital adequacy, how much adequate capital the bank is holding. The bank is holding the good capital or not. Asset quality, that is the non-performing assets of the bank is decreasing or not. Okay, the non-performing asset of the bank is decreasing or not, or the gross non-performing assets, the net non-performing assets, the provisions that the bank is maintaining. So what are the numbers and how the GNPAs or the NNPAs are reducing. The management, how efficient the management is, how much liquidity the bank is following. E is for earnings, E is for earnings. The bank is under the profitable condition or not. So this is the idea. So the risk score of a bank is determined for the tier 1 on the basis of the risk-based supervisory ratings of the Reserve Bank of India, on the basis of the quantitative assessment of the financial health through the capital adequacy, asset quality, management, earnings, liquidity parameters. Okay, potential loss. Now the third criteria is, or the third component is, that how much loss will happen to the deposit insurance fund of the DICGC in case a bank fails. So if there is a big bank, if there is a very big bank like the Punjab National Bank or Bank of Baroda and such, Union Bank of India and such, so if such a big bank is failing, then there will be more, risk that there will be. If a big bank is failing, then the deposit insurance fund loss will be more, okay, of the DICGC. So potential loss, the DICGC also sees that what is the potential loss to the deposit insurance fund in case of the failure of an insured bank. If a small bank fails, then it will not put a lot of pressure on the deposit insurance fund, but if a big bank fails, then it will put a lot of pressure on the deposit insurance fund. So it is also seen that how much potential loss the DICGC deposit insurance fund will face in case a bank fails. On that basis also the risk score is decided. So risk score for tier 1 is decided on the basis of 3 parameters, that is supervisory ratings provided by the Reserve Bank of India for the bank, the quantitative assessment of the financial health through the capital adequacy, asset quality, management, earnings, liquidity and such. Okay, potential loss to the deposit insurance fund. Now tier 2 risk assessment model. In the tier 2 risk assessment model, the risk score of a bank will be determined by DICGC based on 2 important components, that is quantitative assessment of the financial health through the CAMELS parameter and the potential loss to the deposit insurance fund in case of failure of an insured bank. So quantitative assessment, as I discussed with you, quantitative assessment for the tier 1 and tier 2 model banks will be based on objective financial parameters like the capital adequacy and the capital that the bank is maintaining. The tier 1 capital that the bank is maintaining, the tier 2 capital the bank is maintaining. That is, the bank is maintaining the common equity tier 1 capital, okay, the common equity tier capital. So the capital that the bank is maintaining, the most liquid, common equity tier 1 capital is the most liquid kind of capital that the bank can use immediately or the bank can use in the distress kind of situation. Tier 2 capital is not so liquid capital. So the financial parameters in this, we also see the quality of the composition of capital, that how much tier 1 capital, how much liquid capital the bank is maintaining, how much the most liquid capital the bank is maintaining, and how much the less liquid capital the bank is maintaining. So under the quantitative assessment, the objective financial parameters are seen like the capital adequacy, how much capital the bank has, as well as in the capital, how much is the liquid capital, how much is the not so liquid capital, that is composition of capital. Asset quality ratios, what is the gross non-performing asset, is it reducing? What is the net non-performing asset, is it reducing? The provisions that the bank is maintaining, is it increasing? So all of this is seen by the quantitative assessment. Liquidity that the bank is maintaining, profitability indicators. So E is for the earnings, right? E is for the earnings of the bank. That is the profitability indicator, the earning ratio or the earnings that the bank has, and other parameters are seen by the quantitative assessment. Now in the tier 2 model, in the tier 2 risk assessment model, there is also the corporate governance parameter that is also taken into account. Okay, so tier 2 model, specifically for the tier 2 model, under the quantitative assessment, there is also the corporate governance parameter, such as the key management personnel, the board of management, professional directors, are they good or not, are they efficient or not. Okay, so this is also seen as the non-financial parameter or criteria under tier 2 model. In addition to the financial parameter, in addition to the quantitative parameter or financial parameters, there is non-financial criteria that is also taken into account, that is corporate governance parameters. Okay, now next is in tier 1, like all the scheduled commercial bank other than RRBs were there. So in the tier 1, there is the small foreign banks that come under the tier 1 and the small finance bank, they come under the tier 1. Weightage of supervisory ratings, that is the weight of the supervisory weightings will be shifted to quantitative assessment. For the small foreign banks and small finance bank, the weight of supervisory ratings will be taken under the quantitative assessment. That means supervisory ratings are not required in case of small foreign banks and small finance bank. The focus will be given to the quantitative assessment, and the weight that is given or the weightage that is given to the supervisory rating would rather be given to the quantitative assessment. That is what has been said here. Now next is local area banks and payment banks will continue to pay the card rate, because we have talked about the scheduled commercial banks, small finance banks, small foreign banks. We have talked about the RRBs, cooperative banks. What about the local area banks and payment banks? They will continue to pay. They will not come in tier 1. They will not come in tier 2. They will continue to pay the card rate, that is the 12 paise per 100 rupees of accessible deposit per annum. That has to be paid on the half yearly basis, as there are data point limitations. That's why the local area banks and payment banks will have to continue paying the card rate. For them, the risk assessment model will not follow. I hope this is clear. Now, next is rating. Now we have discussed that how the risk score will be given to each of the bank. Okay, so the tier 1 banks will get the risk score on the basis of supervisory ratings, on the basis of the quantitative assessment, on the basis of the financial parameters, and on the basis of the potential loss that happens to the deposit insurance fund. Tier 2 banks will get the risk score on the basis of the quantitative assessment, on the basis of financial parameters, as well as the corporate governance parameters, as well as there is the potential loss that is seen for the deposit insurance fund if a bank fails. Okay, so these are the criteria on which, according to which, the risk score will be decided for a bank. According to which the risk score will be decided for a bank. Okay, so this is the idea, that what is the supervisory rating of the bank, what is the quantitative assessment, and the potential loss to the deposit insurance fund if the bank fails. So on this basis, the risk score is provided to a bank. Now, the risk score that is provided to the bank, so based on the risk assessment score, based on the risk assessment score obtained by the DICGC, each bank will be categorized into 4 groups. So on the basis of the risk assessment score that is calculated by the DICGC for a bank, the bank will be divided into these categories A, B, C or D for the purpose of determining the applicable premium rate. So if a bank is in the A category, that means the bank will get the discount, the maximum discount of 33.33% in the premium payment. So rather than paying 12 paise per 100 rupees, the bank will only have to pay 8 paisa per 100 rupees, that is the discount of 33.33%. If the bank is falling under the category of B category, risk rating category of B, then the bank will get the discount of 16.67%. So rather than paying 12 paise per 100 rupees, the bank will have to pay 10 paise per 100 rupees. If the bank is falling in the C category, then the bank will have to pay, rather than 12 paise per 100 rupees, the bank will have to pay 11 paise per 100 rupees, that is the discount of 8.33%. If the bank is falling in the D category, how much is the discount? There is no discount because the bank is the most risky bank as it is falling in the D category. So the bank will have to pay the card rate. The bank will have to pay 12 paise per 100 rupees. That is the idea. So this is the idea. The rating of the bank determines that how much premium the bank has to pay. The rating of the bank, the risk rating of the bank determines that how much insurance premium the bank has to pay. If the rating of the bank is A, the bank gets a discount of 33.33%. That means rather than paying 12 paise per 100 rupees, the bank only has to pay 8 paise per 100 rupees. So this is the basic idea. So category A includes the safest of the banks, the least risky banks, while category D includes the riskiest ones. Earlier, all banks had to pay the 12 paise per 100 rupees flat rate, but now the banks will have to pay according to the risk category that they fall in. Okay, so no matter how risky or safe the banks were previously, they had to pay 12 paise per 100 rupees, but now the amount they pay depends on their risk category. So discount or the risk model incentive. So this is the discount, we can say 33.33% of discount, or this is the incentive for the bank that has less risk. Okay, which represents the highest permissible reduction. Chalo. So this is done. So on the basis of the risk categorization, on the basis of the risk, the insurance premiums will have to be paid by the banks. Now it is said that there is another kind of incentive that the banks will get. Okay, another kind of incentive that the banks will get, that is known as vintage incentive. The vintage incentive is given over and above the risk model incentive. So over and above, let's say a bank is getting the incentive of 33.33% that the bank will get on the basis of the less risk that the bank has. But over and above this incentive, the bank can also get the vintage incentive. Okay, the bank can also get the vintage incentive. Now, what is this vintage incentive? There is an incentive that is risk model incentive that sees the riskiness of the bank. If the bank is less risky, there is more incentive that is given to the bank. Okay, the less risky bank gets more incentive. Now, there is another incentive that is vintage incentive. Vintage basically means like vintage wine or vintage, some product is vintage. That means it has been for a long period of time. So vintage basically means that the bank has been present for a long period of time. Not only the bank has been present for a long period of time, but the bank also has a clean track record, or the bank has been stable for a long period of time. So that is vintage incentive. This rewards the long-standing banks with a clean track record. So what is the vintage incentive? Vintage incentive, first of all, it is given over and above the risk model incentive. Okay. So risk-based premium framework also provide benefits for vintage. So there is vintage incentive that is also given. Banks are rewarded for long-term stable operations. So let's say State Bank of India, it has a long-term stable operation. So the State Bank of India, without failing, it has been providing insurance premiums for a long period of time. Let's say that you are taking health insurance. Now you have paid the health insurance for 10 years without falling sick or without having any major kind of disease and such. So, but you have been paying for the health insurance for the past 10 years. So slowly and slowly in the upcoming years, your health insurance premiums will be deducted, because you did not take any coverage, you did not take any money out, you did not claim any money. So your health insurance premiums will be reduced. The amount that will be taken from you will be reduced. Okay, or the coverage that will be provided to you will be increased. So that is the same idea here, that the State Bank of India has been providing the insurance premiums for a long period of time without failing, without letting the pressure go to the deposit insurance fund. So basically banks are rewarded for the long-term stable operations without any major stress or restructuring. This reflects their longer contribution to the deposit insurance fund. So they have done the longer contribution to the deposit insurance fund without failing. So vintage incentive is divided again, because there is the tier 1 banks, there are the tier 2 banks. So the vintage incentive is also divided in the same manner, tier 1 banks for the tier 2 banks. Okay, so vintage incentive, tier 1 banks, so 1% premium discount for each year completed. So State Bank of India is, or let's say XYZ Bank has completed 20 years 20 years has been completed by the XYZ bank for the successful operations. So 1% for each year, that means 20% is the vintage incentive. Now the vintage incentive, can it be 100%? No. Vintage incentive can be maximum 25% discount for banks operating 25 years or more. Okay. So let's say State Bank of India is working for 25 years or more, so it can get the maximum 25% of the vintage incentive. Okay, this is the discount that is provided over and above the discount in the risk model incentive. So let's say category A bank, that is State Bank of India, let's say is in the category A, so it is getting the discount of 33.33% as a so State Bank of India falling in the category A in the risk assessment score, so is getting the discount of 33.33%, will also get, because the State Bank of India has been working for let's say 30 years. So it will get the maximum incentive of 25% under the vintage model or under the vintage incentive. So it is getting the discount of 33.33% and 25%. Okay, so that is the idea. So vintage incentive, tier 1 banks, that are the scheduled commercial banks excluding RRBs, so they get 1% premium discount for each year completed, and maximum 25% of discount they can get if they are operating for 25 years or more. No record, but the condition here is that there should be no record of restructuring or major distress in the bank. So State Bank of India, if it wants to get the vintage incentive, it should have no record of restructuring or major distress. Now tier 2 banks, that is the applicable. Now the vintage incentive is applicable to RRBs, regional rural banks, state cooperative banks, district cooperative banks, district central cooperative banks, and tier 4 UCBs. So UCBs are divided into 4 tiers. Okay, tier 1 are the smallest of the UCBs, then the tier 2, then the tier 3, and then the tier 4. Okay, so the UCBs are divided into 4 tiers on the basis of the deposit size. So tier 1 are the small UCBs that have less deposit size, then the tier 2, then the tier 3, tier 4. So tier 4 UCBs are the UCBs that are having the deposit size, or they are taking the deposits of more than 10,000 crores. Okay. So these vintage incentive is for the tier 2 banks is applicable to RRBs, state cooperative banks, district central cooperative banks, and tier 4 urban cooperative banks. Flat 25% premium discount will be provided to them if the bank has completed 25 years of satisfactory conduct without any restructuring or major distress during the period. That is the idea. Any confusion anyone has till now? So you will get the risk model incentive. Let's say you are in the B category. You are getting the 16.67% of the discount. Okay, from the card rate. In the card rate, you are getting this much of the discount. Now, you have been working for 10 years as a tier 1 bank, as a scheduled commercial bank. You have been working for 10 years. So you will get the vintage incentive of how much? 10%. Because you have been working for 10 years. So 1% for each year. 1% of vintage incentive for each year. So 10% in total. So you will get 16.67% of the risk-based incentive or discount, as well as you will get the vintage incentive also. That is in addition of the risk model incentive. Okay. Chalo. In the event of restructuring or major distress, let's say there is a XYZ bank that was working for 30 years. That has been working for 30 years. So XYZ is a tier 1 bank, that is a scheduled commercial bank, let's say. So XYZ is a tier 1 scheduled commercial bank. It was working for 30 years, but in the period of 30 years, in the initial 10 years, it required the restructuring. It came under the major stress, or it required the restructuring. So it has been said that in the event of restructuring or major distress, vintage incentive calculated from the date. So from the date of restructuring, you will start counting the years after the restructuring has happened. Okay, so if a XYZ bank was working for 30 years as a scheduled commercial bank, as a tier 1 bank, let's say it worked for 30 years. So will it get the maximum discount of 25% if the restructuring has happened? Let's say on the 20th year, restructuring happened. So that means after the restructuring has happened, after that the counting will start for the vintage incentive. Okay, so vintage incentive calculated from the date of restructuring or distress. So after this restructuring, then count the years for the vintage incentive. So after the 20th year, that means 10 years for the 10 years without restructuring, or after restructuring basically. So after restructuring 10 years, so for 10% is the vintage incentive. So I hope this is clear that in the event of restructuring or major distress, any bank that has worked for any number of years, let's say in the initial 10 years the restructuring happened. Okay, so for these 10 years you will not get any vintage incentive because there was the requirement of restructuring. So after the restructuring, then the years, the left out years are 10 years. So for the rest of the years, you will get the vintage incentive. So in the event of restructuring or major distress, the vintage incentive is calculated from the date of restructuring or distress. After that, end date of previous financial year, consider for computing the vintage incentive. So till the previous financial year. Now, the effective rate of premium, we have discussed that card rate is basically 12 paise per 100 rupees. So 12 paise per 100 rupees is the card rate. Okay. Now, how much do you have to pay? Depends upon how much a bank has to pay, depends upon. So what is the effective rate? How much the bank has to pay? How much the bank has to pay? Think about it. How much the bank has to pay? Think about it. That risk model incentive was 33.33% for State Bank of India because it is in category A. It is in category A. State Bank of India is in category A. So it is getting the incentive of 33.33%. So how much does it has to pay? 66.66% it has to pay. Now it is getting the vintage incentive of 25%. So that means 25% is the discount. It has to pay 75%. So 12 paise, 66.66% is 8 paise. So after taking out the discount, so basically after taking out the discount, how much has to be paid? 66.66% has to be paid, right? This is what you have to be pay. You have to pay, the bank has to pay. So if the State Bank of India is a category A bank and has completed 25 years of stable operations, if the State Bank of India has completed, that means it is getting the risk-based premium or the risk-based incentive, it is getting 33.33%. So 33.33%. That means this is the incentive that it is getting, it is the discount it is getting, it has to pay 66.66% multiplied by vintage incentive, that is 25%. So what is left? 75%. So it has to pay 12 paise ka 66.66%, that means 8 paise. Now 8 paise ka 75%, around 5 paise I think. So it has to pay that much. That will be the effective rate. So maybe 5 paise. Yes. So this is the idea. I hope this is very much clear. Vintage incentive for the tier 1 bank will be 1% premium discount for each year completed. So if you have completed 10 years, you will get 10%. If you have completed 5 years, you will get 5%. 25% is the max for operating 25 years or more without any restructuring or major distress. But for the tier 2 banks, there is a slight complication that there is a flat rate of 25%. No 1%, no 2%. There is a flat rate of 25% for completing 25 years of satisfactory conduct without any restructuring or major distress. So effective rate will be your card rate, 12 paise per 100 rupees. Okay, so 12 paise is the card rate. Now the discount that you will get depends upon the risk model incentive and the vintage incentive. So if you are in the category A bank, so you will get the discount of 33.33%. That means you will have to pay 66.66% of the 12 paise. And if you have the 25% of the vintage incentive, that means you will have to pay 75% of the 8 paise. Only 75% of the 8 paise. I hope this is very much clear. Chalo. Now, all the urban cooperative banks under the supervisory action framework or prompt corrective action of Reserve Bank of India. So remember this, that the urban cooperative banks, if they are under the supervisory action framework, that means they have like they are in the stressful condition, or the urban cooperative bank is the one that is under the supervisory action framework where the RBI is supervising them, or the UCBs are under the prompt corrective action framework where the RBI has stated that the UCB is under a little stressful situation or the financial condition might not be very good. That's why the bank has been put under the prompt corrective action where the bank is taking certain corrective actions. So if a urban cooperative bank is under the supervisory action framework or prompt corrective action of RBI, they will continue to pay the card rate of 12 paise per 100 rupees, and they will be considered for risk-based premium from the financial year following the year in which the bank exits the supervisory action framework or prompt corrective action. Okay. Now, coming to the end of the slide, so rating override policy, basically the DICGC has the power to override the ratings, to override any kind of incentive, to not provide any kind of incentive if the DICGC wants. Okay. So basically, for a bank, the effective rate is decided on the basis of the card rate, that is 12 paise per 100 rupees, on the basis of the risk model incentive and vintage incentive. But if DICGC wants, it can override the rating as per its board approved policy. So DICGC retains the power, retains the right to override the rating as per its board approved policy. So before the State Bank of India got the category A, now the DICGC can say that no, we are not providing category A to this bank, but we are providing some other category to this bank. So the override may be exercised if adverse information is reported by the Reserve Bank of India, by the banking supervisor, or DICGC's own assessment identifies there is some material risk concern. So XYZ bank, it got the category B of the rating. Risk rating was category B. That means it was getting the incentive of 16.67%. It was getting the incentive of 16.67%. Okay. Now it has been DICGC has the right to override the rating as per its board approved policy if it has been found by the RBI that there is some problem with this bank, or if the DICGC through its own assessment has found some risk concerns regarding this bank. Okay. In such cases, concerned bank, that is the XYZ bank, will be required to pay such premium as assessed by DICGC. So higher premiums might have to be paid by this bank. So previously it might have to pay 10 paise per 100 rupees, and with the vintage incentive maybe it had to pay 9 paise per 100 rupees because there was some vintage incentive was also been provided. But now the DICGC can mandate that no, XYZ will not pay this, XYZ will pay 12 paise per 100 rupees, or let's say 11 paise per 100 rupees. So DICGC can change the insurance premiums. If the DICGC wants, it can override the ratings. Okay, so that is the idea. Now, disclosure policy. So risk rating category will be communicated. Risk rating category, category A, category B, category C, category D. So this will be communicated confidentially to the MD or CEO of the insured bank. That means this kind of rating should not go to the public. This is a very confidential rating that the DICGC is providing. This should not be used for business purposes. It's not like that I am category A bank, deposit more in me, or this bank is category D, don't deposit in that bank. This should not happen. There should be no discrimination in the categorization basis, because this is the internal categorization that the DICGC is doing. The applicable premium based on the effective premium rate. So the applicable premium will be on the basis of the effective rate will be available. Now the applicable premium on each bank. State Bank of India, what is the applicable premium? Let's say 5 paise per 100 rupees, because the State Bank of India got the rating of category A as well as had the vintage incentive also. So it had to pay, because of category A rating, it had to pay 8 paise. But because of the vintage incentive, it got the discount of 25% more. So 25% discount. So then it only has to pay 5 paise per 100 rupees. So the applicable premium will be available on DICGC's Samyak portal at the start of the payment cycle. At the start of the payment cycle, the premium that is applicable on a bank will be informed to the bank. So banks must not disclose or use the risk category for business solicitation. So basically for your business, you cannot use the risk category, you have category A or category B, you cannot use the information in public. Violation may invite penal action. Okay, now how the premium has to be paid, how the assessable deposits will be calculated and such. So remember that the premiums, insurance premium has to be paid on the half yearly basis. First half yearly, second half yearly. Okay, so first half year will be April 2026 to September 2026. Second half year will be October 2026 to March 2027. The deposit base is of the previous half year. That is, for the first half year, the deposit base will be deposits as on March 31st, 2026. And the second half year, for that, the deposit base will be deposit as on September 30, 2026. So that on the basis of the previous calculated assessable deposit, you are giving the insurance premium. Okay. And for the first half year, the payment has to happen of the insurance premium on the basis of the deposit as on March 31st, 2026. The payment should happen by the last working day of the May, and for the second half year the payment should happen on the last working day of November. Okay, so payment timeline is basically after commencement of the half year, but not later than the last day of the second month of the half year. So April, May, June, July, August, September, this is the first half year. So by the last day of the second month of the half year, the payment has to happen. The second half year is October, November, December, January, February, March. So last day, by the last working day of the second month, the payment has to happen. So this is the idea, that the half yearly, like on the half yearly basis, the payment happens and the deposits are calculated for the previous half year. That is the deposit base on which the insurance premium has to be paid, and the insurance premium should be paid by the last date of the second month. Okay, so this is the idea. Any confusion in this? So this is it. Now we will go with the second news article, but any confusion here? Any confusion? So the half yearly payment is decided, half yearly insurance payment or the half yearly insurance premium is decided on the basis of the deposits as on the last day of the previous half year. Okay, and the last date of payment is May 31st. So remember that this is the example that I have shown you. Okay, so that you have the clarity. I hope you enjoyed this kind of example. You will keep this in mind. Okay, otherwise the written can be written format can be a little complicated, so I brought in the table form. Now payment to be made through Samyak portal, the banks will be able to see their premiums, how much they have to pay the insurance premium. The bank will be able to see in the Samyak portal, and the bank has to pay the premiums in the Samyak portal also, and the payment should happen by the second month of the first half year and by the second month of the second half year. Okay, that is the idea. Chalo, now coming to the RBI Digital Payment Index for September 2025. So basically, Digital Payment Index, this is the index of the Reserve Bank of India that was released since January 1, 2021. So RBI has been releasing the Digital Payment Index. RBI has been releasing the Digital Payment Index since January 1, 2021. Okay, since January 1, 2021. So the RBI has been releasing the Digital Payment Index. So the RBI has been releasing the Digital Payment Index since January 1, 2021, and the Digital Payment Index, it captures the extent of digitization of payments across the country. It captures the penetration of the digital payments and the deepening of the digital payments in the country. So that is the idea of the Digital Payment Index that was launched and that has been released since January 1, 2021. It shows the penetration and the deepening of the digital payments in India, and the DPI is released on the half yearly basis. So Digital Payment Index for September 2025 has been released. Now the Digital Payment Index for March 2026 will be released. Then Digital Payment Index for September 2026 will be released. Most important Digital Payment Index for you will be for March 2026. That will be released in July and such. Okay. So RBI has been publishing a composite Reserve Bank of India Digital Payment Index on the half yearly basis, one for March and one for September. and the data is released with a lag of 4 months. So for September 2025, the data was released in Feb 2026. And for September data, this is usually, the September data is released in Feb 2026 and March data is usually released in July. Okay, so Reserve Bank of India Digital Payment Index is released on the half-yearly basis. One data for the till March and one data till September. This is released with a lag of 4 months. September data is now released in Feb 2026. Now the next March data will be released in around July 2026. So that will be more important, but let's understand the Digital Payment Index. Digital Payment Index captures the extent of digitization, the deepening and penetration of digital payments in the country. Now base year is 2018. See, base year, it provides a reference. So base year for Digital Payment Index is 2018. Base year value is 100. Now the base year, it provides a reference period, it provides a reference value against which the coming data can be compared. So base year, it provides a reference point against which we can compare the coming values, against which we can compare the coming years and the data, so that there is a long-term analysis that can be done. So base year, usually the index, they usually have the base year against which the other values can be compared. So the index for September 2025, the index for September 2025 value was 516.76, while the value for March 2025 was 493.22. So if you see the long-term analysis, long trend analysis, if you see that there has been increase in digital payment index, and since 2018 to September 2025, from 2018 till 2025, there has been great increase in the digital payment index. That means there is the deepening and penetration of digital payments that is happening. So I hope this is very much clear. The Digital Payment Index, it is a very important index that shows the deepening and penetration of the digital payments in the country. And the March 2018, it is the base that has the value 100. So the March 2018 is the base year and 100 is the base value against which the other years, the other data points can be compared easily. Now the index for September 2025, the value is 516.76. So there is the increase that we have seen in the digital payment index value. Now how the value is determined? So digital payment index, it depends upon 5 parameters. Digital payment index, it is calculated on the basis of 5 parameters. Payment performance, that has the highest weightage of 45%. Then payment enablers, that has the weightage of 25%. Then payment infrastructure supply side, that has the weightage of 15%. Then payment infrastructure demand side, that has the weightage of 10%. And consumer centricity, that has the weightage of 5%. The question has come from the subparameters of the digital payment index also. So let's discuss them. So payment performance, payment enablers, they basically enable the payment. That is internet. You require internet to do the UPI payments, or to do the payments you require the internet. There is mobile Aadhaar card that is required. Then there is the Aadhaar enabled payment system that you will be able to use, or through the Aadhaar card you will be able to connect your bank account with the UPI and such. Bank accounts are required, participants, merchants are required. They are the payment enablers that allow or that initiate, that help in the initiation of the digital payments. Payment infrastructure demand side is basically what we have as consumers. We have the debit cards, credit cards, we have the prepaid payment instruments like the Paytm wallets and such. Customer registered mobile and internet banking through which you can use the NEFT, RTGS, IMPS and such. FASTags we have, through which we do not have to pay cash in the tolls, and we just just the scanning of FASTags are required. Payment infrastructure supply side, on the supply side we have the bank branches, business correspondents that are the extended arm of the banks that connect with you, ATMs, POS terminals, QR codes, intermediaries. These are from the supply side, okay, which allows you to make the payments, which allows you to conduct the digital payments. Now payment performance, that is basically the digital payment system volume. The volume of payments is increasing. The volume of payments means number of digital payments are increasing. So payment performance shows that there is the increase in the number of digital payments, or increase in the value of the digital payments. Unique users, the new users that have started doing the digital payments, UPI, NEFT, RTGS and such. Paper clearing, that is the checks check clearing that is happening through the check truncation system, through the digital, semi-digital system, we can say. So the paper clearing is happening through the digital system. Currency in circulation has reduced. That means the cash, the physical cash, physical money that we are using has reduced, and we are doing more digital payments, and there is the less physical cash that is being used, less physical money that is being used. Cash withdrawals has reduced because there is more digital payments that is happening. So this all shows the payment performance. Consumer centricity, basically the awareness and education, the declines that is happening in the payments, if they have reduced, the complaints, how much complaints are coming, the frauds have they reduced, system downtime has they reduced. So that is consumer centricity, that revolves around the awareness, education that the consumers have. So these are the 5 parameters, and these are the sub parameters. Remember the parameters and the sub parameters and the weightage. This whole slide is very important. Question has come from the weightage also. The question has come from the sub parameters also. Okay. Now coming to the next last part, that is the increase. Now the RBI digital payment index value has increased to 516.76. Okay. So the digital payment index value has increased to 516. Now, why this value, digital payment index value, has increased in September 2025? This is basically because of the payment performance and the payment enablers. So the increase in RBI DPI index for September 2025 was driven by significant growth in parameters, that is the payment performance and payment enablers. These are the 2 main reasons in the increase in the RBI DPI value. A question has come in the previous year from this part also, that why the DPI has increased. So RBI DPI has been constructed with March 2018 as the base year, as the base period, as the reference point, as the benchmark point. DPI score for March 2018 is set at 100. Going forward, it was said that RBI DPI will be published on RBI's website on a semi-annual basis, that is for March and September, with a lag of 4 months. So March, usually for the March the data is released in July, while for the September the data is released in January or February. Okay, so that is the idea. Now this is the first question. I hope you will be easily able to answer this question. I hope you enjoyed the session, and this is the first question in front of you. So try to answer this question. Vicky, we have discussed in the monetary policy index, in the monetary policy statement. So in the monetary policy statement for your Feb 2026, that the CPI base year and for the real GDP, the base year, they have been changed. They have been announced to change. Okay. So now in the next monetary policy statement that will be released in April, then we will discuss about it more, because it was stated that in the monetary policy statement the new base years will be used. Okay, so if you want to know about the base year, you can see the monetary policy statement video for the Feb 2026, in which we have discussed already about the change in the base year. So monetary policy statement for Feb 2026, this we discussed, and in that we discussed about the change in base years. Okay, for CPI as well as for the real GDP also. Now this is the second question. I hope you will be easily able to answer this question also. So this is it. Thank you very much for joining the session. I hope you enjoyed the session, and do write down the homework answers. Okay. Thank you everyone. Thank you for joining. So in the comment section, do write down the homework answers. Let's see how many of you are able to answer the questions correctly, and I will reply to whoever who gives the right answer, okay, in the initial 24 hours. So thank you everyone. Thank you for joining. I hope you enjoyed the session. Thank you.